Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. This week's episode of Cross-Border Tax Talks, we're in Lisbon, Portugal at PwC's Global Tax Symposium, Europe 2024, where I'm excited to have Andy Wiggins on the podcast. Andy is a UK partner based at PwC and PwC's Global Tax Accounting Services Leader. Andy, welcome to the podcast.
Thanks, Doug. Good to be here.
So, Andy, you're from Birmingham in the UK. Birmingham? Birmingham?
Yes. Doesn't matter. Just as whoever you like.
You don't mind how the Americans
No. I was going to say, yeah, it happens all the time.
It's hard for me to pronounce H-A-M on anything other than ham when I think you said him.
Birmingham.
Birmingham. Okay. So I assume many people think that you're from London, like many people assume I'm from New York City, and I'm obviously live in St. Louis. Why do you choose to live in Birmingham?
So I went to university in Birmingham, and met my wife there, and we both got jobs in Birmingham, and we've just never left. Really, it's the second city. It's got a big population. It's commutable to London. It's about an hour and 10 minutes on the train, so it's not too bad.
I'm not sure that you're ready for the director of tourism there yet, but
that's not too bad.
It's not too bad. It's commutable to London. But I understand. I live in a smaller city.
Yeah.
My wife, my family are both from there in St. Louis. I went to university relatively close, so I get it. All right. Well, we're here to talk about a really complex and important topic for the entire tax community, at least those companies that have greater than 750 million euro revenue, and that is the tax accounting implications of Pillar 2. So why, Andy, is Pillar 2 important for public multinationals from an accounting perspective? Let's just start at the highest level.
Yeah, so I think there's sort of two aspects to this. The primary aspect is if there is a Pillar 2 liability, that needs to be booked, obviously, in the 10K, in the grid financial statements. But it's bigger than that. It's not just work out the liability and get it in your financial statements. There's the financial statements are the primary starting point for the Pillar 2 calculation. So understanding how the numbers are pulled together for the consolidated financial statements becomes really important. And as you know, Doug, basically, this is the first time we're going to have a tax return that starts with a consolidated set of financial statements, right?
Right. And I mean, this has been kind of a common thing, all these firsts, right? For the first time that we have tax payments directly tied to consolidated accounts, the first time a country by country report, which we'll get into, can impact actual tax liabilities. All right. So this is a question that I get a lot as I travel around the globe, and I always send it your way and your team's way. What are some of the differences between US GAAP and IFRS when it comes to accounting for Pillar 2? And specifically, how has the ISB for IFRS taken a different approach from the FASB for US GAAP?
Yeah, and part of this is history, right? So obviously in the US, you had an alternative minimum tax in the past from a domestic perspective. So there was guidance already within ASC 740, which sort of dealt with how to deal with an alternative minimum tax. And so the FASB has sort of analogized Pillar 2 to your historic AMT and applied that guidance, which gets to an in period, then what deferred tax is result. The ISB and IS12 didn't really have anything in with regard to AMTs. And so therefore they couldn't analogize to one, and they couldn't follow any guidance. So they had to make an amendment to IS12. So there was when the Pillar 2 rules sort of landed, there was a very short period from the ISB's perspective of a 15-month consultation amendment to the standard, which is super quick from an accounting perspective to deal with how to account for Pillar 2. So they have then specifically identified do not book deferred taxes in relation to Pillar 2, and then required some additional disclosures above and beyond what you would normally have, because by giving that specific exemption, they felt that users of the accounts needed some further information in order to, understand what Pillar 2 meant for that individual company.
And my understanding is that the sort of no deferred accounting rule is just temporary. And what does that mean? How temporary is it?
Yeah, that's a great question. We don't know. So I think, because it was such a rushed process to get something, because to book deferreds on Pillar 2 would be mind-bogglingly complicated.
Yes.
Scheduling out if you think it's hard to produce your Pillar 2 calculation in 1 year, imagine doing it on a forecast period going forward and working out the rate that it reverses out and trying to book that. That would be too hard. And it was too judgmental, too uncertain. So they said, okay, right, well, let's just put a temporary exemption in for now, figure out, how Pillar 2 lands, how comfortable people get with it, see whether there are aspects of it which we think would give the readers of the accounts better insights if they brought deferred tax back in again at a later point in time to give that forward-looking perspective of Pillar 2's impact. And if not, then maybe they would make it permanent. But that's a decision to be made in the future.
Yeah, this is very interesting to me, and I am not a CPA or qualified accountant, but so we see this with taxing authorities or policymakers as well. They just take different approaches, and sometimes I wonder if can't you just go on the internet and see how somebody else has done this because other people have thought of this before. We dealt with this in the U.S. with GILTI, right? And so the first income inclusion rule and you're right. The AMT was kind of the first one, and then the US GAAP and the ISB specific was like, okay, well, for GILTI, you can use the period accounting, but they also allowed companies if they wanted to do the full deferreds, and it was a relatively very small group of taxpayers that took that approach. So I found it very interesting. That was with the FASB. I thought it was very interesting that the ISB sort of took their own approach and has looked at it as temporary. And the question that I have is it's not really going to get it easier, right? To be able to rules are kind of the rules, and so. But I understand that they kind of want to wait to see how the dust settles.
Yeah, exactly. Well, because they didn't have a length of time to consider it properly. And one of the differences between the ISB and the FASB, obviously the FASB tends to very much focus on US domestic. ISB has to consider the rest of the world, which obviously has a lot of variance, right?
Yeah, it's a great point. Okay. And maybe unpack that a little bit because, as a sort of US GAAP sort of centric guy, explain that because the FASB, really, you're right, it's just focused on US GAAP, but the ISB, explain some of those other standards. It's a really good point.
Yeah. So I guess, the ISB has introduced the sort of standards back in 2005, in particular, more to apply to a lot more stock exchanges, a lot more public filing countries than necessarily just the US, right? It's across Europe, it's across Asia. And so therefore they've got to consider not only how the impact of a rule change in one territory would apply, they've got to consider the whole globe as well. And that just sort of puts them, and that's why the consultation period takes longer as well, because unintended consequences is something that everyone wants to avoid.
Yeah. As a tax practitioner, when this whole Pillar 2 started, I did not have the appreciation for the differences between these different accounting standards around the world. It's sort of like, well, of course there are, but I just never really mattered to our earlier point. And so, for example, for my time in Japan and Japanese GAAP, and then traveling around Europe and talking to our colleagues in Europe. And I was kind of shocked to learn that there are a number of territories that don't do deferred tax accounting.
Absolutely.
For example,
Yeah.
You wonder if the OECD policymakers that were thinking about covered taxes, that the numerator is supposed to include deferred taxes. There are a number of accounting systems around the world that just don't account for deferred taxes. And that has been a sort of eye-opening for me. And your point is well taken with the ISB. Well, they need to consider all of these different potential accounting systems and standards as they're giving guidance.
Yeah, absolutely. So you've sort of got different levels, haven't you? So for the main markets, for publicly listed companies, they tend to be either IFRS or US GAAP in the US. When you get down to statutory entity level, of course, more often than not, that's dealt with by local GAAP. So it could be French GAAP, German GAAP, etc. And away you go. And all of those are different individually. And so then you end up with all these gap differences.
Right. And, taxpayers are having to learn a lot of these rules, particularly, and we're going to talk more about this, like with QDMTTs, for example, because some of the QDMTTs are based on the local accounting standard. Some is based on the financial accounting standard, the ultimate parent. And we've got schedules to think about what some of those key differences are, particularly as we're thinking about programming our Pillar 2 engine. It is amazingly complex. All right. So we're going to step back again before we dive into some of the details. And what, Andy, should taxpayers be thinking about with respect to materiality for Pillar 2, and particularly to kind of dive into this group versus statutory level? Because I think that may be taking some taxpayers by surprise as they think about materiality, and particularly as they start thinking about year ends.
Yeah, and again, I think there's probably a US, non-US aspect to this. So in the US, more often than not, materiality is going to be determined based on the set of financial statements that you're producing. So if you're producing a set of consolidated financial statements in the US, it's just you've worked out the group materiality, you then apply that to what is the exposure that you think you may have in relation to Pillar 2, what's the potential issue, and then you audit to that level. But in sort of the rest of the world, yes, you've got the consolidated financial statements, but you've also got all of these statutory financial statements for all your subsidiaries. And materiality is based off of level of revenue, profitability of the business, etc. So clearly, as you get to smaller and smaller subsidiaries, if there's an exposure to Pillar 2 because of a QDMTT or whatever, then you're going to need to be able to get comfortable in relation to your Pillar 2 calculations at that far more granular level of materiality than your group consolidated financial statements. More often than not, the timing for those is delayed compared to external the group consolidated financial statements, which generally, especially if you're listed, quite quick production, needs to be out fairly soon after the year end to inform investors, etc. Statutory accounts tend to be a bit later in the year, but not in every territory. Every territory, again, has a different time frame for when they need to be done. You're going to need to get comfortable that if you've got a QDMTT in country X and country X files by, the end of March, you've had to audited and got comfortable with the level of detail in your calculation at country X. Statutory entity level might be, a few noughts less than what your group materiality is.
Yeah, we're going to unpack this a little bit more, but I think just as a teaser, that the many companies are expecting to rely on the transitional safe harbor. They operate in a high tax jurisdiction. There's no incentives. They're like, oh, we can meet the transitional safe harbor. There shouldn't be any Pillar 2 top up tax, right? And then you have to ask the question, do you have a qualifying country by country report? And, with the latest administrative guidance, with the June administrative guidance for this year, we'll talk a little bit more about that. But then companies may say, well, even if it's not qualifying, it's not material. But like that point of, it's not material at the group level versus material at the statutory level. It's just something I think for taxpayers to keep an eye on. But we'll come back to the transitional safe harbor. Let's talk about now risk assessing. So what should taxpayers think about? And this is, I appreciate a complex question, but what should at a high level taxpayers think about risk assessing the level of work that's required around Pillar 2? And maybe even like, for those of us that do tax and not accounting for a living, well, why is that risk assessment important? in the context of, tax accounting?
Yeah. So
Just auditing in general.
that's right. That's right. If once you've determined your materiality, you then determine, okay, so what is my risk of material misstatement? So I look at all my calculations, whether it's Pillar 2 or whether it's just my income tax accrual, and say, okay, what's the chances of that being materially wrong? And that might be in particular jurisdictions. So, because that jurisdiction's big, it might be a jurisdiction because it's a low tax jurisdiction, or it's a super complex jurisdiction, or it's a country that has high risk of challenge from the tax authorities, whatever it might be. And then you take into account both quantitative and qualitative factors to determine, I can't look at every single country in the world because an audit is not re-performance 100% of all the numbers, right? We'll be there all year for recreating everything that the company's done all year. So you've got to work out where are those risks, and that's got to be by quantum or by qualitative factors that you need to take into account. Pillar 2 is no different.
Okay.
So you say, okay, where are my biggest jurisdictions? Where is it most material? Where am I going to get that? And then I've also got to overlay, where are my low tax jurisdictions? Where am I most likely? Where's my tax rate less than 15%? Where do I get, super deductions, R&D credits, whatever it is that are the big adjusting items that I would expect to flow through from a Pillar 2 perspective to give me a lower ETR at the end of the calculation.
Is a company's sort of internal process and kind of analysis of that process included as part of that risk assessment?
Yep. Yeah, absolutely. That's got to be the starting point, because ultimately, especially, from a US perspective where you've got Sarbanes-Oxley and controls, that would be one of the controls. The company needs to do that. And the rest of the world, there's differing levels of control requirements depending on which country you're in as to how much a company should have done their own risk assessment. As an auditor, I come along and sort of say, okay, well, look at the company, how they got comfortable that their numbers are right. How do I then check to make sure that they haven't missed anything, or, in terms of understatement or overstatement?
All right. So now I want to move on to some of the specific sort of the QDMTT, IR, and the UTPR. And we can frankly dedicate 30 minutes for each of those. But maybe just briefly, how should companies be accounting for QDMTT, or what are some of the important things they need to be considering when we'll start with the QDMTT, since that's first in the ordering?
Yeah. So essentially, where the liability lies. So if a QDMTT is sort of calculated on the country level, maybe by local GAAP, maybe by group GAAP, depending on the territory, what they've said in their rules. And so if I take the UK as an example, the one I know the best, so there is an option of, we'll use group GAAP and we calculate it on the territory level, but then allocate it to all the individual statutory entities, right?
Within the UK.
Within the UK. But we can then make an election to nominate a single company just to, from administrative ease, essentially, is the reason. So depending on whether somebody is, let's say there's a 10 of top-up tax in the UK, it could be spread one across 10 companies, or they can make an election and put all 10 in one legal entity. So we would expect it to be booked wherever whoever's got the liability.
Got it. How the UK taxing authorities are going to audit QDMTTs on US stuff, US GAAP concepts is still beyond me, but it's early and we're going to see all this stuff shakes out. But that's not an accounting issue.
Yeah.
It's just some commentary on the overall system. All right. So what about income inclusion rules? So that's really, that sort of top down, and now can all of a sudden include a whole bunch of other foreign subsidiaries, whether it's applied at the UPE level or at an intermediary holding company level.
Yeah. And broadly the same applies, right? So it's no different to a CFC tax. So it's if it's the liability of the UPE, then that's where it's going to be booked. Going back to one of your earlier questions, in the UK, for example, when we publish our consolidated financial statements, we quite often publish that UPE set of entity accounts at the same time. So going back to the materiality point, when even when we're looking at consolidated financial statements, we then have to also audit at that UPE entity level materiality at the same time.
All right. So last one that I want to mention, and this one has not taken effect yet, at least as of this recording, and that's the UTPR. In the UK recently proposed some rules, which soon to be enacted, which is the undertaxed profit rule, which generally will come into effect in 2025 for those jurisdictions that have enacted. So what should companies be thinking about of these sort of preparing for that Q1, if you will, of the UTPR?
Yeah, UTPR is sort of a bit harder.
Yeah.
So it's really hard to get your head around. You know, this is up, down, left, right. You know, you need to sell everything in order to work out your own liability.
Right.
And that makes the whole process that much harder to figure out, well, where should I be booking everything? That is still under debate and discussion across a number of territories, across the firms, trying to figure out, you know, what are we all going to do about this? You know,
I can't even wrap my head around the accounting perspective.
I know it is, you know, I guess we'll come up with a number of options. We'll figure it out. And guidance will be issued in due course, I'm sure.
When I assume that guidance from both the ISB as well as FASB presumably needs to be evident, it should be evident.
Well, so of course, you know, for consolidated financial statements, it makes no difference, right? Because it's just aggregated. It's very what's the top up test. It's only when you get to that. So quite often it's even harder than this, right? Because you need to know what French GAAP's going to say, German GAAP, and everything else, because it's all those statutory accounts, which is even harder.
Yeah. Okay. All right, we're going to move on from that topic. And any suggestion that I have that we can do a separate podcast on that, I'm not sure I want to touch that. All right. So we had talked about the Pillar 2 requires the integration of tax concepts and consolidated financial statement reporting. So I want to hear a little bit how companies are approaching getting ready for Pillar 2. And the way I think about this from a tax perspective is we have sort of the input, sort of the data strategy, and then we have the calculation and the calculation strategy. And I've been cautioning taxpayers that those are two very different things that companies need to get ready for, getting that data readiness, and then also understanding all the bespoke adoption for each of the particular countries, just from getting this calculated. Let's start with inputs and data sources from an accounting perspective. And why is that important from an accounting perspective?
Yeah, and I guess it's because they are the starting point numbers for the Pillar 2 calculation itself, right? Yeah. So if you get the wrong accounting data, which historically when you're doing a tax return, certainly outside the US, that's based off of those statutory accounts that have been audited. So it's very easy for tax authorities to tick profit number.
Yep.
Because it's in a set of audited financial statements. Here, we're talking about a set of consolidated accounts that have been deconsolidated, essentially. And you might have booked things at different levels in the ERP system. You might have late adjustments. You might have central adjustments like share-based payments, things like that, or that are held at different places in your financial statements or in your consolidation system. And what we've seen, the more I've sort of spoken to companies about this, every company seems to have set up their ERP systems differently. Everyone's set up the way that they do their group consolidation differently.
Not all the data sources are even all those systems.
And so all of a sudden, this all becomes really quite complicated to get the right starting point number. Even just getting your FAML that you start with in terms of the calculation, what is that? Because it's not in a separate set of consolidated financial statements.
Yeah, and I think really the message that I would give for listeners is that data point is obviously critical for both the accounting from an accounting perspective, and then obviously also to actually calculate to just do the numbers. And so for those listeners that have fiscal year ends, start early.
Yeah.
All right, because for those of the calendar year ends, hopefully they've already started. All right. What about sort of from an output perspective and, the potential detailed calculations or the transitional safe harbors?
Yeah. So I guess it depends, when you're in the When you're placing reliance on transitional safe harbors, the question then becomes, how many of your jurisdictions, does every jurisdiction qualify? Some that don't, in which case you've got to think about full calculations. All of that's got to feed into whatever it is that you're going to book in your group financial statements. And going back to what I said earlier, the ISB, so IFRS reporters, are going to have to disclose any Pillar 2 taxes, and Pillar 2 taxes are defined as all three areas, so QDMTTs, income inclusion rule, and UTPR. All three of those are Pillar 2 taxes. They have to be disclosed in the tax notes separately. So even if it's a below material number and you've calculated it, you're still going to be disclosing that separately. So understanding what that looks like, what are you going to say about it, what narrative, if any, are you going to put alongside it, understanding that early is really important for groups.
Great. So what are some of the challenges with determining a reporting group for Pillar 2, and specifically who is the UPE? And so the reason I ask that is that that's based on whether you consolidate for financial accounting.
That's blend on the accounting rules.
Right. So all of us, so as tax folks, have to call you accounting folks and be like, all right, what is consolidation? Is this consolidated? So just maybe briefly talk a little about that.
Yeah. So I guess the types of groups that we're talking about, private equity backed, and also private groups, right? Because sometimes there might be a trust, which obviously, family-owned businesses. Yeah, exactly. So there might be a family trust that sits at the top of the corporate chain. Well, trusts are a constituent entity for Pillar 2 purposes. A trust doesn't have any requirement to produce consolidated financial statements. So obviously you have to look at control, and there are slightly different guidelines within US GAAP compared to IFRS, but essentially you follow through those. It's who's got control, what's being consolidated in those accounts. If you don't have the requirement to produce a set of consolidated accounts, as you know, it requires you to deem a set of consolidated accounts at wherever your UPE is. So it is important. That's clearly got to be one of the first things you do, is understand where is your UPE, and how many different constituent entities you have in your group and where they will sit.
Okay. So now I want to turn to the transitional safe harbor, and specifically companies that are relying on the country by country report for the transitional safe harbor rules. You talked a little bit about the precision and process, but can you talk about, and this is, I think, an accounting type term that I've learned since I've been in the Pillar 2 game, which is what is the top down versus bottom up approach? Right? What do taxpayers need to be thinking about for their country by country reporting process?
Yeah, so quickly to explain top down, bottom up. So we've talked about statutory financial statements. Well, the CbCR rules basically said you can use all of those individual statutory accounts that are produced in France and Germany and UK and everywhere else, and you can aggregate all of those to make your CbCR, and that is one way of producing your CbCR. A top-down approach is use your consolidated financial statements and then deconsolidate them back into country level and remove all the consolidation adjustments. So hence why you've got a top-down being consolidated down into countries, whereas bottom-up is statutory accounts aggregated into countries.
So how can that impact, or I guess more broadly, what should taxpayers be considering as they're trying to determine whether they have a qualifying country by country report? And I appreciate that is a loaded, complex, big complex question, but any sort of just broad principles or things that taxpayers from an accounting perspective need to be aware?
Yeah. So if we take bottom up first, you mentioned earlier that certain jurisdictions don't have deferred tax in their statutory accounts. So if you're doing a bottom-up approach, and then you've got to follow whatever is in the local GAAP standards in terms of that aggregation. So you might be foregoing any debits associated with deferred tax because there is no deferred tax in those, and you can't add in extra because then they're no longer qualifying financial statements. People forget that bit. And then it needs to be in a country which is listed in the Pillar 2 rules to be a qualifying gap. So if you're in a particular country that's not on the list, then it's never going to be a qualifying financial statements. So there are a number of things with bottom up, but what I see far more with taxpayers is a top-down approach. And that's because it can be a centralized process. It's something that the central team can have more control over. And basically that starts with the consolidated financial statements and deconsolidates them. And you might say, well, why would you start at the top and deconsolidate rather than think about reporting packages in the OECD language, which is all the reporting packs that aggregate up? Well, I always like to think of it as deconsolidate it down so that you don't miss any of those adjustments that sit topside.
Yeah, and that's certainly a trend that we're seeing as the centralization. We talked a lot about it here on the podcast for multinationals, just given the complexity and the data needs that it's basically accounting really starting sort of at the parent company. And I think, the number of taxpayers that have even historically done the bottoms up approach, looking more to move to the top down approach. Andy, what should taxpayers be considering when moving from the transitional safe harbor to the full globe rules? So obviously those transitional safe harbor rules can potentially apply for 3 years, but if you fall out, or maybe if you don't have to qualify country by country report, for example, briefly, any kind of key things that people should be considering?
Yeah, well, obviously the transition rules apply from November 2021. So, transactions that you've had, intercompany group transactions, which, you might have transferred assets from country A to country B, or a single asset from country A to country B. You need to have tracked that, understand what the tax base is associated with that. You mentioned the June 24 guidance that came out earlier this year. That sort of gives some guidance around how to deal with that. And you might have a third set of books. You might have your local statutory accounting books. You might have your group consolidation books. And now you've got your OECD set of books because you might end up with notional deferred tax created as a result of the June 24 guidance in relation to things like that. So all of that means understanding all those transactions that might be caused and tracking of them. The sooner you start tracking them, assuming there's never going to be a permanent safe harbor that gets a country out forever, then you're going to have to fall into the full rules at some point. And then you're always going to have to go back to November 21. So tracking early is beneficial.
Very important. Exactly. And even sort of, might need some hindsight now if you've not been through that process. So it might even require kind of going back and looking. And that's why I always describe this as it's a whole new set of books. And, effectively requires sort of retroactively going back and looking at what were these transactions that took place during the transition period, where there's a lot of transition words here. So we've got the transition period, and then we have the transitional safe harbor. When going from the transitional safe harbor to the full globe rules, you then have to go back and look at the transition period. They should have come up with that. All right. Well, this has been fascinating. Maybe sort of to wrap things up, Andy, what are some of the best practices you're seeing with tax teams partnering with accounting teams, and any general words of wisdom you have for taxpayers that are either getting ready for year end or for what is the envy of many multinationals, those fiscal year taxpayers that have extra time? What are some of the closing words of wisdom that you have?
Yeah, I guess working with finance is so important in my mind. Finance teams are the ones that own that consolidation process. They own systems, they own all the adjustments. Understanding at a far more granular level than we've ever needed to understand, because it's ultimately now going to form part of your tax return, right? Knowing whether an adjustment topside is truly a consolidation adjustment, whether it is truly not a consolidation adjustment and it's just late because, the adjustment was identified late on, or it's a bonus provision because they couldn't work out the bonuses until they got the accounts pulled together. Those things are not consolidation adjustments. They're just timing adjustments. They were just booked later in the process. They should be down in the entity. Understanding all of those, like the share-based payments, those central adjustments, The only reason they're done centrally is because it's easier to do centrally, but they need to be pushed out. So they're not consolidation adjustments. So understanding the granularity is really, really important. And if any changes are needed in that consolidation process, you need finance on board to do that. So engaging and getting them bought into this, and they're the ones probably going to be providing the vast majority of the data. So this pillar 2 is very data heavy, as we all know, we've all heard about, and therefore finance is a critical part of that needed. What are the sort of key things? I would say the other key people to involve really early is your auditors. Sure. Understanding what they're going to accept. If you're going to be relying on transitional safe harbors, then are you producing those transitional safe harbor calculations, your CbCR real time, or are you relying on a historic one? How are you rolling that forward? What is it that they're going to audit? Are they going to require you to reconcile your CbCR report to your consolidated financial statements because they need a point of reference that they've audited? Tracking all of those adjustments become really important. Understanding that with your auditors, I would say, is high on the list.
Great advice, Andy. Fascinating discussion. I'm still thinking about the future of the accounting guidance for the UTPR, which I must make my head explode. So we'll see what guidance we get that and bring you back to talk about that and other issues of the Cross-Border Tax Talks podcast. Thank you very much for coming on.
Thanks for having me.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Andy Wiggins, PwC's Global Tax Accounting Services Leader. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.